Warren Buffett says diversification is what you do when you don't know what you're doing. Ray Dalio says it's the only free lunch in investing. Both are worth billions, both are legendary, and they completely disagree on one of the most fundamental questions in investing. Omaha, Nebraska, 1994. Warren Buffett stands at the Berkshire Hathaway annual meeting. A shareholder asks him about diversification. Buffett leans into the microphone. His voice has that characteristic folksy confidence. Diversification, he says, is protection against ignorance. It makes very little sense for those who know what they're doing. The crowd laughs, they get it. Warren Buffett doesn't diversify. Berkshire's portfolio is famously concentrated, 5 to 10 positions. Sometimes one position represents 20 or 30% of the entire portfolio. Apple, Coca-Cola, American Express. He picks companies he understands, buys them cheap, and holds forever. That's the Buffett way. Cut to Westport, Connecticut, same year. Ray Dalio sits in Bridgewater's offices reviewing portfolio construction. He's looking at correlation matrices, risk decomposition analysis, mathematical models showing how different assets behave in different economic environments. He turns to his team. We need at least 15 truly uncorrelated bets. Any less than that and you're not actually diversified. You're just holding a bunch of positions that'll all go down together when the wrong scenario hits. Two investors, two completely opposite philosophies, both wildly successful, both managing billions, both respected by their peers, and they fundamentally disagree about one of the most basic questions in investing. Who's right? Here's what I've discovered after spending months studying both approaches. They're both right, but they're solving completely different problems. And understanding that difference, really understanding why Buffett concentrates and why Dalio diversifies, that's going to change how you think about building wealth. Let me start with Warren Buffett's argument because it's simpler and honestly, it's pretty compelling when you first hear it. Buffett says, look, if you really understand a business, I mean truly understand its competitive advantages, its economics, its management, its future, then why would you dilute that conviction by owning 50 other things you understand less well? He uses this example. If you went to top business school and had to pick the 20 best students who you thought would be most successful over their careers, would you pick 20? Or would you identify the absolute top 5 and bet everything on them? Buffett's argument is that by the time you get to company number 20 on your list, you're reaching. You're compromising. You're settling for your 20th best idea instead of concentrating on your very best ideas. And there's real logic to this. If you're certain, truly certain that Coca-Cola is going to compound at 15% annually for the next 30 years, why own anything else? Just buy Coca-Cola, sit back, get rich. The math works beautifully if you're right. Buffett lives this philosophy. In the 1990s, he put a massive portion of Berkshire's portfolio into Coca-Cola. Not 5%, not 10%. We're talking about a position that at one point represented over 40% of Berkshire's equity portfolio. One company, 40% of the portfolio, that's not diversification, that's concentration taken to an extreme. And it worked. Coca-Cola went from $5 a share to around $80 over his holding period. Massive returns, exactly what Buffett predicted. His conviction was rewarded. But here's what's interesting. That same concentration almost destroyed Buffett earlier in his career. This is something people forget. In 1962, Buffett had a massive position in a company called Dempster Mill Manufacturing. He was so concentrated in this one position that when the stock dropped, it nearly wiped out his entire partnership. He had to frantically sell the position, liquidate the company's assets, and restructure his entire portfolio. He learned from that, but his takeaway wasn't diversify more. His takeaway was pick better companies and hold longer. That's the Buffett philosophy. Get better at picking, not more diversified in holdings. Now let's talk about Ray Dalio's completely opposite approach. Dalio comes from a different world. He's not picking stocks. He's managing macro risk. He's thinking about currencies, bonds, commodities, equities, credit, inflation, deflation, growth, recession. He's looking at the entire global economic system and asking what could go wrong. And his fundamental insight is this: you don't know which scenario is coming next. You might think you know, you might have high conviction. But the history of markets is filled with brilliant people who were absolutely certain about what would happen next and were catastrophically wrong. Dalio knows this personally. In 1982, he was certain, absolutely certain, that the US was heading into a depression. He'd studied every debt crisis going back to the 1800s. The pattern was clear. Mexico defaults, contagion spreads, credit freezes, depression follows. He was so convinced he went on television and told everyone to get out of stocks. He was wrong, spectacularly, career-endingly wrong. The market rallied. His fund nearly went bankrupt. He had to borrow $4,000 from his father just to survive. That failure created Dalio's entire investment philosophy. He realized that no matter how smart you are, no matter how much research you do, you cannot consistently predict which economic scenario will play out. So instead of trying to predict, he built a portfolio that would survive and even profit in any scenario. That's the all-weather portfolio, and the name is literal. It's designed to work in all weather conditions, all economic environments. Rising growth, rising inflation, falling inflation, 4 possible quadrants. The portfolio has assets that perform well in each quadrant. Let me break this down specifically because it's really important. Dalio divides the economic world into 4 scenarios. First, rising growth with rising inflation. That's an economic boom. You want to own stocks and commodities in that environment. Second, rising growth with falling inflation. That's the Goldilocks scenario. Stocks perform great, bonds do well, everything works. Third, falling growth with rising inflation. That's stagflation, the 1970s. You want to own commodities and gold. Cash gets destroyed. Fourth, falling growth with falling inflation. That's deflation, depression. You want to own long-term government bonds. They absolutely scream higher when deflation hits. Now here's Dalio's key insight. You don't know which quadrant is coming next. Buffett might say, well, I can analyze the economy and figure it out. Dalio says, no, you can't, not consistently, not reliably. So instead of predicting, build a portfolio that has meaningful exposure to assets that will perform in each quadrant. That's why the all-weather portfolio looks so different from Buffett's portfolio. It's 30% stocks, 40% long-term bonds, 15% intermediate-term bond, 7.5% gold, 7.5% commodity. It's spread across everything, and critically, those assets have low correlation to each other. When stocks crash, bonds usually rally. When inflation hits, gold and commodities protect you. When deflation comes, those long bonds save you. The mathematical foundation is what Dalio calls risk parity. Most people think diversification means owning a bunch of different things. Dalio says no, that's not real diversification. If you own 30 stocks but they all go down together when the market crashes, you're not diversified. You're just holding multiple expressions of the same risk. True diversification, Dalio argues, requires uncorrelated return streams. And his research showed that you need at least 15 truly uncorrelated bets to achieve meaningful risk reduction. Not 10, not 20. The math says 15 is the minimum where additional diversification really starts to reduce portfolio volatility without sacrificing too much return. Think about what that means for a second. Buffett is saying concentrate in 5 to 10 positions if you know what you're doing. Dalio is saying you need at least 15 uncorrelated positions even if you're a genius. Complete opposite approaches. So who's right? Well, let's look at what happened during the 2008 financial crisis because that's the stress test. That's where we see both philosophies tested under extreme conditions. Warren Buffett's concentrated equity approach got destroyed. Berkshire's stock portfolio dropped from around $100 billion to around $60 billion, 40% decline. And remember, Buffett doesn't really diversify across asset classes. He's in equity, maybe some cash, but when equities crash, he crashes with them. His concentrated positions in companies like Wells Fargo, American Express, and Coca-Cola all drop together because they're all stocks. They're all correlated to the equity market. Now, Buffett held through it. He didn't panic. He actually bought more at the bottom. And over the next decade, he made all that money back and then some. So if you define success as long-term wealth creation and you have the stomach to ride out a 40% drawdown, Buffett's approach worked fine. But Ray Dalio's Pure Alpha Fund did something completely different. It made money during the crisis. Pure Alpha returned positive 14% in 2008 while the S&P crashed 37%. How? Diversification. When stocks crashed, his long positions in government bonds rallied hard. When credit markets froze, his systematic rebalancing captured opportunities in dislocated assets. His gold position protected against currency concerns. His exposure to multiple uncorrelated bets meant that while some positions lost, others won, and the portfolio as a whole stayed positive. That's the fundamental trade-off. Buffett's concentrated approach gives you higher returns in bull markets but massive volatility in crashes. You need the emotional fortitude to watch 40% of your wealth disappear and do nothing. Most people can't handle that. Most people sell at the bottom. They panic. Dalio's diversified approach gives you lower returns in bull markets but way lower volatility in crashes. You might not make as much when stocks are soaring, but you don't lose as much when they're crashing. And critically, you don't get emotionally destroyed. You don't panic. You don't sell at the bottom because the losses are manageable. Now here's where this gets really interesting. Both investors are optimizing for different variables. Buffett is optimizing for maximum returns given his stock-picking ability. He knows he's better at picking stocks than almost anyone alive, so it makes sense for him to concentrate in his best ideas. Diluting that edge with bonds or commodities or other asset classes would actually hurt his returns. His edge is in equities, so he concentrates in equities. Dalio is optimizing for consistent returns regardless of economic environment. He's not trying to beat the market by 50%. He's trying to make 7 to 12% per year every single year, whether we're in inflation, deflation, growth, or recession. He wants returns that don't depend on being right about which scenario comes next. Different goals, different strategies, both work, but they work for different types of investors with different capabilities and different risk tolerances. Here's what I think most people miss when they try to apply these lessons. You're probably not Warren Buffett. I'm not Warren Buffett. We don't have his 50-year track record of identifying undervalued companies. We don't have his relationships with management teams. We don't have his access to deal flow. We don't have his ability to analyze business economics at that level. So if we try to copy Buffett's concentrated approach without his stock-picking ability, what happens? We concentrate in companies we think we understand but actually don't. And we get destroyed when we're wrong. That's what happens to most retail investors who try to pick 5 stocks and get rich. They don't have Buffett's edge. They just have Buffett's concentration risk without Buffett's ability. Dalio's approach is more accessible for normal people precisely because it doesn't require genius-level stock picking. You're not trying to find the next Apple. You're building a systematic portfolio that captures returns across multiple asset classes and rebalances mechanically. You don't need to be smarter than the market. You just need to be disciplined enough to maintain the allocation. That said, there's a psychological challenge with Dalio's approach too. It's boring. In a raging bull market, you're watching your friends who are 100% in tech stocks make 30, 40, 50% while you're making 8% in your diversified portfolio. That's hard, really hard. You feel like you're missing out. But then the crash comes, and your friends lose 50% while you lose 5%. And suddenly the diversification doesn't seem so boring anymore. It seems like genius. Let me give you a specific example of how this plays out. 2020 through 2024. We had this wild period, massive stimulus, rising inflation, tech stocks soaring. If you were concentrated in Nvidia and Microsoft like a lot of people were, you made absolutely insane returns. 300, 400% in some cases. The Buffett concentration approach applied to the right stocks printed money. But if you were concentrated in the wrong stocks, say commercial real estate or regional banks, you got absolutely destroyed. Those sectors dropped 30, 40, 50%. Concentration works brilliantly when you're right and catastrophically when you're wrong. Dalio's all-weather approach during that same period did something different. It made steady returns, not spectacular, not 300%, but consistent, 7 to 9% annually. The stock allocation captured some of the equity gains. The bond allocation protected against rate volatility. The gold allocation hedged inflation concerns. The commodity allocation benefited from supply chain disruptions. Different pieces of the portfolio worked at different times. And here's what's critical. At no point did the all-weather portfolio require you to predict what would happen next. You didn't need to know that tech stocks would soar. You didn't need to know that inflation would spike. You didn't need to know that interest rates would jump. The portfolio had exposure to assets that would benefit from each scenario. Whatever happened, something in the portfolio worked. That's the philosophical difference. Buffett says, I'm going to predict which companies will succeed and concentrate in those. Dalio says, I'm not going to predict which economic scenario will play out, so I'll own assets that succeed in each scenario. Now let me address the obvious question. Can you combine both approaches? Can you use Buffett's concentration in areas where you have genuine edge and Dalio's diversification everywhere else? Potentially, but you have to be really honest with yourself about where you actually have edge. Most people think they have edge in stock picking when they don't. They've read some articles, looked at some charts, and convinced themselves they understand a company better than professional analysts who have been covering that sector for 20 years. That's delusion, not edge. If you work in a specific industry and genuinely understand the competitive dynamics better than outsiders, maybe you have edge there. Maybe you can concentrate a portion of your portfolio in that sector. But the rest of your portfolio probably makes sense to diversify it using something closer to Dalio's framework. The key is intellectual honesty. Buffett has earned the right to concentrate because he's proven over 50 years that he can pick stocks better than almost anyone. You haven't earned that right unless you have a similar track record, and if you don't, trying to copy his concentration is just gambling. Let me also point out something about time horizon because it matters enormously for this decision. Buffett can handle massive short-term volatility because he has a 40-year time horizon. He doesn't need the money tomorrow. He can watch his portfolio drop 40% and sleep fine at night because he knows it'll come back over the next decade. Most people can't do that. Most people need their money in 5 or 10 years for retirement. They can't afford to have their portfolio cut in half and wait 10 years for it to recover. For those people, Dalio's lower volatility approach makes way more sense even if it means slightly lower long-term returns. There's also the psychological component. Some people are wired to handle volatility. They can watch their net worth swing wildly and not panic. Those people might be suited for Buffett's concentrated approach. Other people get physically ill when their portfolio drops 10%. They panic, they sell at the bottom, they make emotional decisions. Those people absolutely need Dalio's diversification because the volatility will destroy them psychologically before the market comes back. Here's my take after studying both approaches extensively. For most people, Dalio's framework is more appropriate. Not because it generates higher returns, it probably doesn't, but because it's more robust. It works in more scenarios. It doesn't require you to be Warren Buffett. It doesn't require you to correctly predict the future. It just requires discipline. Buffett's approach is incredible if you have his abilities, but it's dangerous if you don't. And most people don't. That's not an insult. Warren Buffett is literally one of the best capital allocators in human history. Expecting to replicate his results by copying his concentration is like expecting to play basketball like LeBron James because you wear the same shoes. The beauty of Dalio's system is that it democratizes access to professional-grade risk management. You don't need to be a genius. You don't need insider information. You don't need decades of experience. You just need to understand the 4 economic quadrants, build exposure to assets that work in each quadrant, rebalance mechanically, and stop trying to predict what happens next. That's accessible, that's replicable, that's something an average investor can actually execute successfully over decades. One more thing I want to address. Some people hear diversification and they think it means mediocre returns. They think, oh, if I diversify, I'm settling for average. That's not what Dalio's arguing. His pure alpha fund averaged about 12% annual returns from 1991 through 2020. That's not mediocre, that's phenomenal. He's not sacrificing returns by diversifying. He's reducing volatility while maintaining strong returns. The key is that Dalio's diversification isn't naive diversification. He's not just buying an index fund with 500 stocks. He's carefully constructing uncorrelated return streams across asset classes and rebalancing to maintain risk parity. That's sophisticated diversification. It takes work, it takes understanding, but it doesn't require you to be Warren Buffett. So here's what I want you to take away from this. Warren Buffett and Ray Dalio represent 2 completely valid but fundamentally different approaches to building wealth. Buffett concentrates in his best ideas because he has the skill to identify them and the temperament to hold through volatility. Dalio diversifies across uncorrelated assets because he knows you can't consistently predict which economic scenario comes next. Both work, both have made their practitioners billions, but they're optimized for different things. Buffett optimizes for maximum returns given exceptional stock-picking ability. Dalio optimizes for consistent returns regardless of economic environment. For most people, Dalio's framework is more appropriate because most people don't have Buffett-level stock-picking ability, and most people can't handle Buffett-level volatility without panicking. The question isn't which approach is better. The question is which approach fits your abilities, your psychology, and your time horizon. Answer that honestly, and you'll know which path makes sense for you. Now I want to hear from you. Are you more naturally drawn to Buffett's concentrated approach or Dalio's diversified framework? Have you tried both? What happened? Drop a comment below because I'm genuinely curious how different people think about this trade-off. If you found this valuable, hit that like button and subscribe. We're releasing new Ray Dalio deep dives regularly, and you don't want to miss them. I'm your host, this is legendary investor, Ray Dalio, and I'll see you in the next one.